We will be discussing how to value a stock, a topic that I'm sure will be of great interest to a large number of you. Therefore, by the end of this video, you will understand the step-by-step process for determining the intrinsic value of a stock, as well as why we do it the way we do it. But first, why do we do this and what is valuation? We're attempting to estimate the future cash flows a business will generate for its owners, in order to determine what we're willing to pay today for those future cash flows in order to achieve a high rate of return over time. We imagine the business we wish to acquire to be a money printing machine. Picture it as a robot that can print a particular amount of money per year. Throughout the year, we might find a technique to raise the robot's printing pace by 10, or the robot's existing owners may have ignored it, causing it to become rusty and produce less money each year. The idea is that it is a machine that can print a specific amount of money each year, and it is our responsibility to determine how much we would be willing to pay for it. Welcome to Financial Fortune. If you found this video helpful, don't forget to subscribe to the channel and give it a thumbs up if you want to better your financial future. For instance, the Microsoft robot is presently selling for a total of $1.85 quadrillion. That's a lot of money, but would you pay it? Obviously not if the robot could only earn $1 million per year, but would you or should you pay $1.85 trillion if the robot could generate, for example, $100 billion per year? This is a difficult subject, and we'll get to it in a moment, but the first thing to keep in mind is that these firms are just cash-generating machines, and it is our responsibility to determine how much cash they can generate for us in the future. To estimate a price, we must consider how much we would be willing to pay to acquire them immediately. Next, let's study how to determine the inherent value of a corporation. Warren Buffett loves to reference the famed American economist John Burr Williams, who stated that the intrinsic value of any stock, bond, or business today is determined by the cash inflows and outflows expected to occur throughout the remaining life of the asset, discounted at an appropriate interest rate. This quote is explaining a valuation process called a discounted cash flow analysis, which is what we're going to do in this video. But essentially, it's saying that the intrinsic value of a business is the present value of all its future cash flows, then added together. With that in mind, it's clear that we, as potential new owners of this money printing machine, need two important pieces of information. First, we need to know how much cash the business will generate in the future, and second, we need to know how much those future cash flows are worth to us right now. First, we must determine how much cash the business will generate for us in the future. To comprehend this, we must first determine how much money the business is now making for its owners, generally known as the owner's earnings. What is the proprietor's income? Cash flow from operations minus maintenance capital expenditure. The last line of the first portion of the cash flow statement represents operating cash flow, which is the amount of cash actually generated by a business's operations. However, maintenance capital expenditure, which is the amount of money a business must spend to maintain its earnings, is frequently more difficult to calculate. This is due to the fact that businesses are required to report their total capital expenditure, which is the purchase of property, plant, equipment, but they are not required to distinguish between how much is for growth and how much is for maintenance. Some companies do report maintenance capital expenditure, but the vast majority don't. If you're analyzing a company that doesn't report it, you can simply begin with free cash flow, which is operating cash flow minus total capital expenditure, or, as stated previously, the purchase of property, plant, and equipment. Overall, this will make our computation more conservative, but technically it will be slightly less accurate. What we're imagining is that we'll buy the business today, hold it for 10 years, and then sell it. So we'll have to spend a certain amount of cash to acquire it, then we'll receive cash flows from the business for 10 years, and then we'll sell it and receive a one-time large payout from the sale. The next stage is to estimate the future owner's earnings over the following 10 years based on the business's annual growth rate. This is where the discounted cash flow analysis becomes really challenging. You need to be brutally honest with yourself about how quickly you believe your organization can develop over the next 10 years, as employing alternative growth rates complicates the process. You can essentially manipulate the discounted cash flow analysis to say anything. When choosing a growth rate, the most important considerations are to conduct in-depth research on the firm and to, on the side of caution. The next phase is to increase the free cash flow by our 10-year growth rate over the next 10 years, and once we've accomplished that, we'll need to determine the business's terminal value. In 10 years, we will likely be able to sell the entire company for this amount. We have predicted the future cash flows of the business and the price at which it can be sold in 10 years. But those cash flows are not worth very much to us today because we must wait many years to actually get them. According to popular belief, $1 today is worth more than $1 tomorrow. If we had these cash flows today, we could invest them in the stock market and earn a substantial return by the time we are projected to receive them. Hence, we must account for the fact that the further these cash flows are in the future, the longer we will have to wait and, consequently, the less this money is valuable to us today. So, I discount based on the yearly return that I want to accomplish, which is 15%. You could do 10, but if you do 10, you might as well settle for an index fund because that's historically what they tend to deliver annually. You might as well spare yourself a great deal of effort. To complete this phase, we divide our predicted free cash flow by 1.15, which represents the number of years that have gone. We then multiply this number by the number of years that have passed, and finally, we do the same for our terminal value. The present value of all future cash flows is in fact available. From there, the intrinsic value can be determined by simply adding all of the cash flows. This technique actually requires 2 additional steps. First, consider the following. If you thought a house was worth $500,000, but then you discovered $100,000 buried in the backyard, you would obviously be willing to pay up to $600,000. It's the same with businesses. When you buy one, you receive a treasure chest filled with cash. Hence, you must swiftly consult the balance sheet to determine the size of the treasure box. Then add that figure to the sum you are willing to pay. This is the second to last component to examine, but the last thing is a margin of safety. So tell me candidly what you think given all of our estimates and guesses in this calculation, plus the inevitability of future change. What are the odds that our carefully crafted scenario will play out exactly as planned in reality? We must accept that this is merely a guess, as the probability of this happening is nil. It is our best estimate, and because it is an estimate, we add a margin of safety. If you're a newbie, you'd probably like to see a margin of safety of 50%. If you're more experienced in investing and well inside your circle of competence, you might be able to settle for a margin of safety of 30%. Now that you understand how this technique works, you should be able to locate excellent undervalued stocks. What are your opinions on this video, and what would you like us to cover in our upcoming videos? Thank you for viewing.